So I'm going to start with kind of a bit of background for kind of on what we do. One of the things I kind of want to touch on is what it's like in sort of a new area, building genuinely kind of greenfield without any of those kind of disadvantages that you have, like customers, revenue, employees, capital. Those sorts of disadvantages that kind of established players have. We don't have any of those. So that creates some challenges of its own, but also some opportunities. And it's actually been kind of particularly interesting for me listening to things in terms of looking at the way we're choosing to build things and listening to kind of how people are kind of building stuff. And I sometimes lose sight of the kind of where we are and kind of the way we're doing things. I kind of listen to this and realize that, whoa, you guys are way behind, like a long way behind. I was particularly amused by listening kind of the talk on kind of DevOps and sort of deployment systems. We have no DevOps, we have no containers. We don't bother with any of that stuff because you have to have like people doing that stuff, and that's just yak shaving to kind of do things. So we're deploying kind of serverless things direct and letting other things scale for us. So there's some difference, but I'll try and touch on kind of the way we're doing things and kind of how we're touching things and how we interact with the legacy systems, because the old world does still exist out there. First, what do we do? So our target customers are millennials. We're new wave of fintech. We're targeting millennials who uniquely have no money. Which is a slight challenge as a fintech. So we're targeting customers that really don't have any money. Their income's down compared to where it was. Home ownership is a distant dream that they have. They have huge amounts of kind of student debt. Overdrafts, credit cards. Just to give you an idea, our typical customers will have maybe 3 or 4 credit cards maxed out to the limit. They'll maybe have 2 bank accounts with 2 overdrafts in them. They'll be carrying about £15,000 worth of unsecured debt, right? No, it's not all bad. They're probably still living at home with their parents. They're not paying a lot in rent. They don't have kind of, they don't have many commitments, but they're also not really on a path that's going to take them anywhere else from that. So it's actually, not a great time. They might be strutting around the place looking like they rent the place, but, it's really not that great. The system that they're in as well has kind of been designed to make it as easy to do all the wrong things as you can possibly imagine. So the sorts of kind of financial transactions they're doing are moving away from cash, right? It's not like you're getting your £100 out of the cash machine and then you're spending that money for the next 2 weeks, right? And you can see when it's run out because it's literally gone in your wallet. The things that they're spending are on contactless, right? They're on their credit cards, they're on their debit cards, right? And their spending is integrally integrated with borrowing, right? You spend on a credit card, right? Unless you're a transactor, right? That's going to start incurring interest. Thing I didn't realize was that most people probably familiar. You pay for your credit card, right? You don't pay any interest on it. It's great. You get like 45, 60 days worth of interest-free credit. The minute you flip into being a borrower on a credit card, they're charging you interest from the moment you actually transact, right? So there's this real flip. If you're paying off your interest in full, you get this huge amount of interest-free credit. You stop doing that, you're being charged credit, interest straight away. And in the UK, 30, 40% APRs. It's really, really expensive credit. And it's really hard for people to keep track of. And so we see guys like kind of Monzo, Starling, and kind of Revolut who really capitalize this in terms of marketing this kind of, disconnect from your money. When you do a transaction, let's send a push message to your phone just to try and reconnect people. Actually, back to when I started earning and spending, you had to go and get money out of a cash machine. You couldn't get a credit card, right? I was connected with my money because I could see how much I had left at the end of the day, right? It was there. So it's actually kind of, there's a bunch of guys going back trying to take financial services with the tech back to where people were. But we've got a lot of tech now, and a lot of the stuff's connected. And so some of the things that we're looking at is, we've got people building self-driving cars. Why are we not building self-driving money? Really, we should be doing this for kind of people. actually get on top. And if you're at the high end, right, you're kind of wealthy, this is exactly what people are doing for you, right? You can put your money into, active, passive managed funds that will balance it, will manage the risk, will do that, will move things around, will optimize for tax for you, right? At the high end, this is already there, right? At the low end, where people don't have money, it isn't. And so that's really what we've set out to solve, which is really solving this. We'll worry about the savings and wealth creation when we've solved the UK, best part of about 8 million people, right, that have got these other problems. Who are we? So just quickly, so I have to now describe myself as a serial entrepreneur, which is one of those phrases I hate because it's the sort of thing that kind of people say when they've done a bunch of this, but this is now my 4th startup. So I'm afraid that's me. Dave is our millennial. He is actually in the generation, he's actually designing the kind of product for us. And my co-founder, Seem, created this problem in the first place. So he actually used to lend. He was running HSBC's lending in the UK. So he's decided that his options were, purgatory and hell for being a banker, or found something to fix this. So that's us. So what do we do? At a simple level, step 1 is it's mobile led, right? That's where millennials are living. They're living on their phone. They don't have landlines. This sort of stuff, they're not even doing desktops. They don't have the time, right? So mobile led, we're getting them. We're downloading the app. We're linking bank accounts, right? So first step is a horrible integration with a bunch of legacy systems that are honestly appalling. So you sit down, you connect your bank accounts, and suddenly you start to realize how bad these legacy systems are. So I'm going out and I'm spending on my Visa card, right? And I'm watching. It's going to take 48 hours for that transaction to actually show up in kind of any account. Yeah, they knew I had the money right there in real time at the cash point, but to actually be reflected back to me, right, that is taking 48 hours, right? Now, if I'm linking with kind of one of the newer banks, it's not the case. These are happening in kind of real time. But you start to see some of these kind of legacy systems, just how bad they are there. And so we start to kind of pull some of that stuff and then start to, where we can, layer on top of that. When we started, we thought, hey, this is great. We can start adding a load of metadata in here. So we know where your phone is. We know where you were. We can tell what shop you were in when you've sent that. Only it turns out that 48 hours later, when we get the transaction, every single transaction that you did was at midnight. It gets even better because we then find that when we then look in 2 days' time, every single transaction that you did that we've already got was an hour later. So quite what the systems have got that are updating date stamps and rounding them to nearest hours and moving them around, I have no idea what's happening. And these things. So we have a set of kind of layers that we're kind of putting on that start to kind of mask this and put it out. And ultimately, today, we can only get to kind of a cadence of about weekly in terms of being kind of really meaningful for people. It's improving slowly through a mix of competition. So we find that actually a bunch of our customers are starting to shift their transactions to the newer banks that provide the better service. And so you're getting that kind of organic shift. And secondly, more slowly, a bunch of the banks are moving forward and actually kind of improving things incrementally, though bear in mind that genuinely part of my business is talking to TSB's banking systems. You can just imagine quite how bad that can be at times. Once we've done that, we then start to actually look at kind of what your debts are. And there's a bunch of kind of data sources we use for that. We can see an awful lot from your banking transactions. So if you've got credit cards, you're making monthly payments. You've got personal loans, you're making monthly payments. A whole bunch of payday lenders. This industry is fairly heavily regulated for good reasons, which is actually really nice because it means we will know who all the lenders are that are active in the UK. We can go to the register and actually look about who all the regulated lenders are. So we can start to understand kind of who's there, who's lending, and actually kind of find out what's that. And we can start to infer what sort of borrowing rates people are on. We also work with the credit reference agencies who get this data, again, maybe about 2 months later. So it'll take about 2 months for kind of loans to flow through, which is why a bunch of the kind of early stage of the kind of payday lenders came in, was really innovations around new data sources that could start to do underwriting. If you want to lend somebody some money for 3 weeks, right, as a payday lender, if you lend on the 2nd of the month, right, and then they paid it back by the 20th, as far as credit reference agency happened, that transaction never happened, right? Likewise, credit reference agencies looking at kind of overdraft rates, they simply can't tell what people are borrowing, because if the point of the bank sends the data, the snapshot of kind of borrowings happens to be just after got paid, no overdraft, right? So you start to see kind of a bunch of the kind of structural problems in that, and the opening up of kind of the data sources is really starting to kind of open that up, and there's definitely. We're seeing a wave of kind of innovation. Us, also other guys who are starting to kind of hook in and look at kind of other data sources around this sort of thing. So we start pulling in and actually start exposing to people where all their debts are, what things are costing them, and really discovering some kind of, quite surprising things for people. So anybody banks Lloyds or Halifax? Please do not go into an overdraft. Right, Lloyds and Halifax, standard high street, all of their customers get, right, overdraft rates, work out. They're nice and said, beautifully designed from a customer perspective. Like it will charge you 1 pence every £6 every day. You work that out, right, and actually they even do it wrong on their website. You actually work that out, it compounds, right? And we can actually check, we've seen people, right? So, each penny that you borrow is adding up, right? That compounds, works out at 82% APR. Right, so that's what Lloyds and Halifax, right, are actually giving high street customers today, and there are literally millions of people who are borrowing, right, who've maxed out their overdraft, right? They get their salary in, load of bills go out because they've lined them all up, and they're back into kind of maximum overdraft. They're borrowing money at 82% APR forever, right? Because they're not going to get out of that. So we start to pull that in, put that. We then start to help people with kind of payoff goals. So start to give people kind of both reasons to kind of save and then this is the really fun bit, and this is actually this is the entire place that we make money. Up until now, every single bit that we've done has been free to the consumer, right? If you meet our underwriting criteria, we'll make you a loan, and we make loans between 8 and 29%. Right, and those are typically replacing 20 to 80% on APR. So and as a principle, we will never loan, right? So we never loan new money to people. We'll only ever loan replacement money, and we'll never loan money unless we're reducing the cost of the debt. So we just basically go in, and we're playing to replace about £8 billion worth of debt with lower cost debt for people. And this is the point that we make money. Right, so our entire pipeline up to now has basically been pulling in kind of data sources, pulling things, providing people kind of a good and simple to use experience to get them to this point. And same for credit cards, right? It's same offer, right? Slightly tighter margins on this, but the nice thing is people are carrying a lot more debt on credit cards. So of our typical customers, maybe £15,000 worth of debt, they'll maybe have £1,000 to £2,000 in overdraft, right? The remaining balance of the unsecured debt will be about 13,000. Will be across multiple credit cards and store cards that they've got. And then it's really a question of how do we keep them on track, right? So this business is all about risk management. The lending business is all about risk. So we get a bunch of signals in from kind of people, right? What are they doing there? How do we kind of keep on top? How do we manage them? And you cannot eliminate risk in this business, right? So we can get something. We can know everything about a person, right? We can't know because they're not going to be able to know that they're working for Carillion and they're going to go bust. Right, so life happens there. So there is inherent risk in this system. So we can work to mitigate that. We can kind of work with people, but ultimately, in the long term, we're trying to work to mitigate the risk. The best buffer that people are going to have against risk is by having reduced amount of kind of commitments, increased savings. And ultimately, I mean, our goal is to eliminate this sort of kind of debt, actually get people into way more debt, but secured. It's called a mortgage, right? I mean, a mortgage is a fantastic form of debt, right? From both the lender's perspective and from the borrower's perspective, not least because it's an asset that historically has tended to increase in value. So this is the core pitch. This is all live now. What does this look like from the kind of behind the scenes? So we have a mixture of interface with legacy systems, right, where we're going through kind of banks and direct to banks that are, literally batch process systems. We do things like setting up direct debits. Right? So we set up direct debits. So we're working through clearing systems. They're doing batch. They're doing daily updates. That for me to get a response to this asynchronous API on setting up a direct debit, 10 days. Right? We're actually getting asynchronous responses after 10 days in batch processes setting up direct debits. Through to systems that we're kind of getting where we can do things, live in real time. So where we're making kind of, decisioning systems, we'll be running through a whole series of kind of scorecards and algorithms, right, and so on, making decisioning systems in, probably about total 5 to 10 seconds to make a fully qualified decision system that has to meet regulated criteria around kind of lending and affordability calculations and so on that we're having to infer. So some will be signing up, connecting bank accounts, applying, we'll be doing credit checks, we'll be doing interrogations on their kind of bank accounts, calculating kind of affordability, making lending decisions, right, and allocating and basically making them an offer that we're then bound by for 30 days that they could borrow from us. We're not in the business of making really quick loans, so we're not in the kind of that, 5 clicks and bang, the money's in your account, partly because actually for us, that's a risk signal, right? If you really need the money fast, right, you're not the sort of customer that we need. We're looking for people who are being more thoughtful and actually starting to look and be there. So our best customers, we will make an offer to, right, and it will take them 2 to 3 days to accept that offer because they're going away and they're actually checking, are we providing the best rate? Is this real? And so on. Those are our good customers. So whilst we actually can go through and make sort of instant decisioning, we tend to insert some artificial delays in that process because they're risk signals. So we actually find people that come in there will be going, hey, can we, how quickly can you do this? We go, yeah, you've just increased your risk score. Moved yourself outside of our criteria. So we've got external systems we're integrating with. We have a whole set of kind of internal, what I would term as legacy systems. So our internal legacy systems are typically, containerized components that are kind of running on servers. So those mostly for us, so we have a whole bunch of kind of event-driven, our decisioning system is an off-the-shelf system. So that didn't make sense for us to build. There are multiple guys out there in kind of banking insurance who are kind of building decisioning systems that meet all of the auditability criteria. So we have a whole bunch of regulation criteria that we can show how we're making decisions. That solves that problem for us. We have a set of kind of open source. So our core loan management and kind of finance management system is an open source project. It's actually been open sourced for mostly used in Africa for kind of micro lending. It's posted there, and we're actually kind of fairly actively working with them to kind of extend that to kind of meet the criteria. But great, because it has a whole bunch of kind of reporting and so on built in. And then the core systems that we're building are entirely microservice, right? In fact, entirely serverless, right down to our kind of database systems. So we are, we're not worried at this stage about vendor lock-in, right? We are AWS, right, top to bottom. So when somebody is going and opens the app and makes a request, they're authenticating with AWS's Cognito. So nice, secure. I'm very, very glad I did not have to implement their password protocol. So I've read the maths and I still don't understand it, right? So they managed to do password exchange without the password ever passing, leaving the device. So we have that. They have advanced fraud detection to detect kind of strange traffic patterns. We get all of that for literally, it's like, 50 cents per user. Oh, by the way, the first 100,000 users are free. So that sort of scale. So that's how they're authenticating. That's entirely serverless, right? So we have nothing to run and maintain on that. Call requests are going to AWS Lambda function. So literally, nobody's making a request. There is nothing there, right? They're making a request. We're getting instances fired up there, and then that will spread out into a series of other kind of sub-requests, both synchronous and asynchronous there. This project, first time for me, I've used a bunch of kind of different databases there. This project, where we're doing microservices, we're using entirely AWS Aurora serverless, right? Which blows my mind in what this does. So literally, we're making requests, and actually this is fabulous for dev environments. Right? So we have multiple databases around. Normally you have kind of a bunch of MySQL servers. They'll be busy churning away, costing you money over the weekend, right? There. AWS serverless, nothing, right? You make the first request, it goes away, and it's literally firing up an entire server to handle that request, right? And then it keeps it lying around for, I think, about 30 minutes, and then which is tunable, like there. So literally, we scale down to nothing, no running servers on the back end. And this is just SQL, right? This isn't fancy kind of, serverless database or no SQL. This is, I can do full SQL queries, right, across this. That's working fabulously for us there. We also kind of hook in a bunch. I know there was some discussions about sort of business intelligence there. This was a new one for us. If anybody's doing that, I would look strongly at AWS's QuickSight. It's been kind of quite quiet. I haven't heard a lot about it. They only launched it, I think, about a year ago, and they are iterating really fast on that. So we have stuff that we mixture of two things. One, we actually started out by just going like, let's just push the data. Let's sit it on Postgres or MySQL, and that's there. Now we've evolved actually, so most of our data now flows out straight into S3. We sit Athena on top of it there, and then pull that for management information into QuickSight, which basically means we're doing arbitrary SQL queries, right, in real time across a bunch of data that's sat in S3. It's costing $10 a month. Right, some of the stuff is embarrassingly cheap, right, and probably. As I'm looking at this and going, it's all right, the UI's a bit clunky. My CEO comes from kind of an underwriting background, is literally looking at this and going, we probably have better visibility onto underwriting decisions than any other business that's out there, because they're building on more complex systems. And literally, we've just plugged together the easiest things that are coming on and iterating so super fast. So for that $10 a month, they just casually launched a mobile version of it like about a month ago, and we're going, it's like, oh, we've got this dashboard. Oh, look, it's now in a mobile app. There. So part of the fact I'm kind of currently talking my CEO down, we should productize that and charge that about $2,000 a seat to people. There. Yeah. So that sort of infrastructure. And then the final piece that we're doing is, as we shift to more and more event-driven, right, particularly for these 10-day asynchronous requests, starting to kind of use traditional queues, but also Event Bridge, which starts to kind of kick into kind of more structured functions. So more and more of this starts to look like literally nobody's using it, right? There's nothing there. Events come through, the entire system kind of lights up and flows through, and then shuts down again. The best bit is the scale on this. So we've done test scaling. So I actually had a bunch of things where we need to do a batch rewrite of some kind of categorization stuff. Literally, we did this, ran in the simplest way, and we realized that we were just casually, having run the command to redo it, we were processing about 150,000 transactions a second, right? And that was before, that was actually with some things in that artificially slowed things down by batching things up. So we could have been running probably at about 10x that speed with no work on infrastructure, right? No thought about it, and honestly, at the same cost of how we've been doing it. So quite interesting in terms of how we've been looking at it, in terms of being able to scale up, scale down, iterate at very low cost, but then also scale up very, very high for either high volume of processing or high transaction rates. So that's what we do.
Excellent. Thank you so much, Matt. Especially that last bit, that was really great, just to help understand how you're building these apps. Because I know Martin wanted to share that, but I said, Martin, you can't talk for an hour. So that was great. So what I suggest, for the sake of time, is we'll now move on to Laura. So Laura, if you can come on down. And Laura's going to be